This is Horizon's Middle East and Africa. Our top stories this morning. Cooling U.S. inflation spurs a global equity rally. However, Treasury yields climb back up as doubts persist about the quality of the data. The Bank of Japan ends the central bank's bonanza this week with a hike that leaves rates at a 30-year high. The 10-year yield hits a 2006 high while the yen weakens. And TikTok signs deals to create a U.S. joint venture, majority owned by American investors, including Oracle, Silver Lake, and MGX. It's quite a busy Friday for you, but it is good morning to you. It's just gone past 9 a.m. across the Emirates, 7 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersechi, and we are closing out the week with a central bank bonanza. It's been quite a busy past 72 hours. Of course, we just mentioned the Bank of Japan wrapping up what has been a busy 72 hours for central banks, but then also for economic data releases, as we were just mentioning there. And that softer than expected delayed CPI print that we got from the U.S. really still digesting for investors, and some of the questions still looming about what exactly, how much weight to put on some of the data that we did get. Let's take a look at U.S. equity futures trading marginally higher right now. Notably, though, we should point out that S&P E-minis are in the green after ending a 4-day losing streak. We had talked about some of the concern around tech valuations in the AI trade earlier in the week, but we did actually see the S&P closing in the green on Thursday. Micron also helping to bolster some of that sentiment with its best day since April, closing up more than 10%. We also have the U.S. 10-year yield right there, up, about a basis point there. Notable because after we did get that CPI print on Thursday, we did see yields pulling back ever so slightly. So we're watching closely where that goes. Right now, the U.S. 10-year yield at 4.1412 there. Dollar yen also, of course, in focus. The yen extending losses against the dollar after we did get that BOJ decision earlier today. We still are awaiting Governor Ueda's press conference later on today. But right now, it's notable to just see where we are at right now at 156 right there, of course, extending some of the declines that we've been seeing for the yen. And really quickly, let's just bring you Brent crude, headed for a second weekly loss despite some of the tensions earlier this week between the U.S. and Venezuela. Brent crude down now just over 0.1% there to trade below $60 a barrel there. And we've actually seen Brent slipping more than 2% this week. Let's just zoom in, though, quickly on that delayed CPI report that we got out of the U.S. One analyst describing it as one of a kind. And despite some very suspicious holes that we did get, notably in shelter costs, there was enough that we did get in this report for the doves to shift yields lower, as we mentioned. But still, the question is, now that we have seen a bit of retracement in the Asian session, clearly there are some doubts about the quality of the data, especially given that this was coming at a time during the shutdown in the U.S. Now, let's just stick on this story. Underlying U.S. inflation rose in November at the slowest annual pace since early 2021. Meanwhile, the core consumer price index grew 2.6% last month from a year ago. But the report, which has been described as, quote, Swiss cheese by some analysts, comes with some credibility issues. That's due to the lengthy U.S. government shutdown, which limited officials' ability to collect data. Joining us is Anita Krishna Gupta, CIO at Wealthbrix Capital Partners. Anita, thanks so much for joining us. We just mentioned some of the descriptions that we are getting for this data print there. But, you know, some people are noting that potentially this print does signal some genuine easing of price pressures. I wonder what, if anything, it signals for you.
Good morning, Jennifer. Absolutely right. You can describe it as Swiss cheese, but the trend is downwards for inflation, whether it's driven by shelter rent and, of course, oil prices coming down. So the trend from a 3% coming down to a headline 2.7 and a core 2.6. Now, whether the 2.6 or 2.7, it's still a downward trend. And I think that's what's very important for the Fed to continue cutting rates. While the dot plot shows one cut, more analysts, and we're also in the camp of 2 cuts. And if we get a dovish Fed governor in May to replace Chair Powell, I think that's definitely going to happen.
So, Anita, when we look forward, what's your sense of the economic the state of the state of the economy in the U.S. Moving into 2026? Are you confident maybe that it is in fact on a path to stability?
Actually, yes, we do think it's on a path to stability. So in 2025, tariffs was the word of the year, no longer. I think in 2026, we are actually going to be focused on productivity, on growth. Consumer remains very important. We have had the Fed raise their expected GDP growth numbers for 2026. Now, if we're getting GDP growth in the US at above 2%, that is a pretty good clip. What we are also seeing is any kind of an infrastructure buildup in the US. We are seeing defense spending. We are seeing, other consumer indicators are still strong. We're also talking about, money coming into accounts in the US. Now that's still a possibility. But every way that we look at it, the US is stable. Of course, there are always, black swans that, could emerge. But it's looking pretty positive with all the data that we have seen recently, inflation ticking down, growth coming up, and of course, the big boost from AI spend and productivity, which is off and on, but seems to be more on the upside.
Right. Anita, I do want to talk about AI in a minute, but I do want to move to the BOJ, our other top story, because you went overweight in Japan in October. Given what we did see from the BOJ earlier today, do you stand by that move? Do you reposition? Are you waiting to hear from Governor Ueda?
No, absolutely. We went overweight. We are going to stay overweight. There's a lot of positives for Japan at this point, and the weaker yen actually is playing very favorably for exporters. So we've had the short-term, hike at 0.75% overnight. In spite of that, the yen actually hasn't strengthened. You've got the 10-year JGB finally at about 2%. You've got inflation, which is a little, still high at around 3%. So real rates are, still, something to worry about in Japan. But all these are pointing towards, Prime Minister Takaichi's, the fiscal stimulus, the boost to industry, and that's going to continue. And Japan remains an industrial nation, and we think that the equity markets there are going to continue to perform well. It's a leader in robotics. It's leader in some of the automobiles, the hybrids, and the weak yen, again, I reiterate, is positive for Japan industry.
Let's stay on that, because we talk about a weak yen, we talk potentially about a weaker USD. What does that mean for your positioning for risk assets moving into 2026?
So we have a fairly clear view at this point. We would never be out of the US in technology. US remains a growth story for us. At the same point, we do have a weaker US dollar. And when we're looking at growth, it's coming from India, it's coming from the UAE. So some of these emerging market economies have very high growth numbers, whether it's India at an expected about 6.7% for the next fiscal year. The last number was 8.2 for the last quarter. You've got the UAE at over 4.5 to 5% economic growth. So there's a lot outside the US and the weaker dollar, though the UAE, of course, the currency is pegged to the dollar, but India is not. So the INR has been weak. So it's a mix for us in terms of equities. We would say be diversified. These are our three top, allocations: the US, India, and the UAE. And within fixed income, be like emerging market local currency debt. So that's where the weaker dollar comes into play, because EM currencies this year, EM local currency debt is about 15%. That's been a call for us. We also like steepeners in the US. So these are our favorite plays going into 2026.
Great to get your insights this morning. Anita Krishna Gupta, Wealthbrix Capital Partners CIO, joining us there in Dubai. Anita, thank you so much for joining us. Now, let's move on to tech. We're watching Chinese stocks related to TikTok after the company signed deals to create a U.S. joint venture majority owned by American investors. An internal memo from CEO Schultz tells employees that agreements have been made with Oracle, Silver Lake, and MGX. Let's bring in Bloomberg's Edwin Chan from Hong Kong. Edwin, thanks so much for being with us. So this is a Bloomberg scoop. Give us some more insight into some of the details that we know about this memo.
As you just mentioned, it kind of laid out the key details, much of which actually we already knew about. Oracle, Silver Lake, and MGX were the main drivers of a new joint venture in which U.S. investors will essentially take 50% stake. ByteDance will retain 20%, or actually 19.9% below the threshold as required by law, and then existing ByteDance backers, some of which include U.S. entities, will take the other remaining stake. And I think we knew the broad contours of this deal. What Schultz's memo actually did not go into was how the Chinese side views this framework. And I think since September, when the U.S. president mentioned that he had secured a deal and that China looked favorably upon it, it's interesting that Beijing has still not publicly voiced its opinions on the matter.
Do we know yet, Edwin, what this means for ByteDance? Because this had been an issue and a discussion for quite some time. Where does this potentially leave the company in their oversight of TikTok?
So ByteDance will not be operating the data or the algorithm. According to Bloomberg's previous reporting, what's going to happen is they're going to license the algorithm. This is assuming Beijing is on the same page as the U.S. Negotiators. What's going to happen is ByteDance will license the algorithm to this joint venture, which would then adopt it and retrain it and operate it going forward, including any data that's generated from it, which would be stored in-country in the U.S. In terms of ByteDance, they retain a stake. I think we've reported that they will retain also a sizable share of the profit contribution. They will get a large proportion of the profits going forward from this joint venture. It's also important to note that TikTok Global, i.e. ByteDance's international division, continues doing, we think, some of the more attractive businesses such as e-commerce and live streaming and live shopping. TikTok Shop, for instance, remains very much under ByteDance's purview. So it's not like they're completely relinquishing the U.S. market.
Interesting. It's a fascinating story and very massive in the tech world, of course. Edwin Chan in Hong Kong for us, bringing us that scoop. Edwin, thanks so much for your reporting. Now, for a look at some of the other stories we are following today, starting off in Dubai. Dubai police have urged workers and residents to stay home this morning after heavy rain and thunderstorms lashed the UAE. Roads and highways across the city are flooded, and a safety advisory has been issued for motorists and pedestrians. The unstable weather has caused some flight cancellations and delays ahead of one of the busiest travel days for Dubai International Airport. President Trump has given federal workers 2 additional days off this year, closing the federal government on Christmas Eve and December 26th. The holiday order is effective for this year, excusing employees from duty for 3 consecutive days unless agency heads determine they need to work. The New York Stock Exchange, though, issued a statement on its website noting stock market hours will remain unchanged on December 24th and December 26th. And U.S. police say a man suspected of last weekend's shooting at Brown University has been found dead at a storage facility in New Hampshire after taking his own life. Earlier, authorities identified the 48-year-old former Brown student as a person of interest in both the university killings and the later murder of an MIT professor in the Boston area. Saturday's attack at the Ivy League school in the state of Rhode Island killed 2 people and wounded 9. Now, coming up, we turn back to central banks. The Bank of England governor warns the pace of interest rate reductions will slow as the central bank approaches the end point of its cutting cycle. We hear from Andrew Bailey next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. The Bank of Japan has raised its benchmark interest rate to its highest level since 1995. Governor Kazuo Ueda and his board hiked to 0.7% the 0.3% there. Well, hiked after its two-day meeting, sending yields higher. Joining me now is Bloomberg's Paul Jackson for a deeper dive into this. So, Paul, give us a sense of how markets are reacting to this.
Well, this decision, like you mentioned, it's not quite back to the 1980s, but it's certainly back to the 1990s. This is the highest interest rate since the 90s, 30 years since it's been this high. And we've seen the yen weaken a tad after the decision. And we've also seen benchmark yields rise above 2%. And they haven't really been at that level regularly since the late 1990s. Now, I think at this point we've had the decision out, not much commentary around it. This is a heavily telegraphed decision. All our surveyed economists expected this rate hike. So the yen hasn't moved that much from where it was before. So you could say that for the Bank of Japan, round one has gone okay. But we've got round two to come. That's the press conference of the governor this afternoon. And really what the kind of view he gives about the trajectory of rates going forward is going to be key to how the market responds subsequently.
Right. And Paul, what is the expectation for what Governor Ueda might telegraph, if anything?
Well, I think the message he must convey is that interest rates will continue to rise as long as the outlook is realized for the Bank of Japan. Now, we have two board members saying that the outlook is a lot more robust than the bank overall is thinking. In fact, we've got one board member saying they've already reached a level of inflation in line with the price target. So that would suggest that the trajectory for interest rates is upward. And I think markets will be wanting to get a feel for, is this going to be something every 6 months? Or is it going to be slower or perhaps even faster than that? And I think that Ueda must get through this press conference keeping the idea that interest rates could be as fast as once every 6 months or faster.
Well, we'll wait for that press conference, as we know you will too. Bloomberg's Paul Jackson joining us. Paul, thanks so much for walking us through that. And let's just stick on the central bank bonanza. The Bank of England has lowered rates to a 3-year low in a narrow vote. While the rate cut was widely expected, the dose of caution was not, and that sent gilts tumbling. Governor Andrew Bailey told us room for further moves next year is limited, and the central bank will face closer calls on its decisions.
Well, I've been very encouraged by the progress that we've made on inflation. I've been saying for some time that it's going to, we had this, what we called hump up this year. I thought it was going to come down, and it has. And the good news is it's actually coming down a bit faster than I think we thought it would. I'm particularly pleased because there's been an easing of food price inflation, which is really very important. I mean, all inflation is important, but we know that food is salient. It's very salient, and of course it hits those on lower incomes a lot as well. I think now that we're on a path where we'll probably be around this level for a few months, but we think that come the spring, April, May time, we should see another quite sharp drop and take us, I hope, to around target. So we're going to come back to target sooner than we thought. So that's encouraging. All of this is very encouraging. And for me, certainly, it was a strong basis to cut today. It's the 6th cut we've made. Now, looking forwards, I do think we'll continue to have something of a gradual downward path. We'll have to judge the evidence, as you know, at every meeting. We'll come back for the meeting at the end of January, early February, and do that. The calls do get closer, but because as we come down, we will approach a level which is going to sort of, in a sense, maintain inflation. It's not going to be too hot or too cold, if you like to borrow that phraseology. It's very hard to know exactly where that level is, but we will approach it. We're approaching that level. We must be approaching that level in a sense mathematically. So the calls will become closer, and I would expect the pace of cuts therefore to ease off at some point. But I'm not going to judge exactly when that is because it's too uncertain at the moment.
And that was Bank of England Governor Andrew Bailey speaking there. Now, the European Central Bank has left interest rates unchanged for a fourth straight meeting as inflation hovers around target and the euro area weathers global shocks. ECB President Christine Lagarde says policymakers will act one meeting at a time based on incoming data.
We reconfirmed that we are in a good place, which does not mean that we are static. There was a unanimous decision that was taken today concerning the rates that we decided to hold, but there was also a unanimous view that all optionalities should remain on the table.
And coming up, oil heads for its biggest annual drop since the pandemic as tankers sit idle with nowhere to offload their crude. We'll bring you that story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Angola has secured $753 million in financing to speed up development of the Lobito rail corridor, ending months of delays tied to talks over government guarantees. The U.S. International Development Finance Corporation and the Development Bank of Southern Africa are providing the funds to upgrade about 1,300 kilometers of railway linking the mineral terminal at the port of Lobito to Luau on the border with the Democratic Republic of Congo. Liberia has approved a major rail agreement that clears the way for U.S.-backed Ivanhoe Atlantic to develop an iron ore mine in neighboring Guinea. Lawmakers ratified the deal, giving the company access to a key railway that links the Guinean deposit to Liberia's port of Buchanan. Ivanhoe Atlantic plans to start building the mine in 2026 and begin shipments the following year. And Ghana's unemployment rate rose to 13% in the third quarter, up from 12.6%, creating a new challenge for President John Mahama. Youth unemployment climbed sharply to 34.4%. The increase comes despite signs of economic improvement, including slower inflation, a stronger cedi, and solid growth. And those were just a few snippets of the stories we'll be covering in our monthly show Next Africa. That airs tonight. Catch the full episode on your terminal, our website, and on TV. Plenty more coming up. This is Bloomberg. This is Horizons Middle East and Africa, our top stories this morning. Cooling U.S. inflation spurs a global equity rally. However, Treasury yields climb back up as doubts persist about the quality of the data. The Bank of Japan ends the central bank's bonanza this week with a hike that leaves rates at a 30-year high. The 10-year yield hits a 2006 high while the yen weakens. And EU leaders agreed to loan Ukraine $106 billion for the next 2 years to keep the war-torn country afloat, pivoting from a plan to use frozen Russian assets. It's just gone past 9:30 a.m. across the Emirates, 7:30 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersechi. Happy Friday to you. It has been quite a week of central bank activity and, of course, economic data activity, sort of culminating with that CPI print that we did get in the U.S. yesterday, which some analysts are describing as Swiss cheese, and some actually saying take it with the entire bottle of salt. So we'll get into that in just a minute. Let's just take a look at where U.S. equity futures are right now, looking like unchanged, as you can see there on the board. Though what's been notable is that we did see the S&P index and most of the U.S. indices actually on Thursday, ending their 4-day losing streak. Of course, we mentioned some of the concern around tech valuations and the AI trade earlier this this week, potentially getting a bit of support from Micron, having an upbeat forecast and actually having its best day since April on Thursday, closing up more than 10%. So we have seen a bit of positivity for U.S. equity futures to start the day on this Friday. We'll watch where it goes right now, a bit unchanged right now. The U.S. 10-year yield also in focus, up about 1 basis point there. We had mentioned some of the initial moves after we did get that delayed CPI print on Thursday. We saw yields actually pulling back, but now we have seen some of that retracement happening. The U.S. 10-year yield at about 413.92 there. The dollar yen also in focus. The yen weakening and slipping against the dollar after the BOJ raised its benchmark interest rate as concerns really swirl about the future of the BOJ's path of rate hikes. And as we spoke to our reporter earlier, we are waiting for Governor Ueda's press conference in just a few hours to get some more insight into potentially what the messaging is that he gives us. And really quickly, Brent crude headed for its second weekly loss despite some of the tensions that we did see between Venezuela and the U.S. earlier this week. Brent has slipped more than 2% this week, down below $60 a barrel there to trade just down about 0.2%. And really quickly, let's just zoom in on that delayed CPI report out of the U.S. As I mentioned, one analyst describing it as one of a kind. And despite some of the suspicious holes that we did see in it, notably in shelter costs, we did see enough of a move for doves to shift yields lower, as we did notice. And still, the question is, especially as we do see some of that retracement in the Asian session, how much doubt is there about the quality of the data that we did get in November, that we did get on Thursday for that November print? Now, let's turn to the African continent, and specifically here in South Africa. To South Africa's inflation, it eased more than expected in November, lifting hopes the central bank could cut interest rates as soon as next month. Consumer prices rose 3.5% from a year earlier, down slightly from October, and closer to the Reserve Bank's new 3% target. Joining us is Jeffrey Schultz, head of CEEMEA economics at BNP Paribas Markets 360. Jeffrey, thanks so much for being with us there from London. Let's just start here on the print that we did get. Were you surprised by this print, especially if we consider some of the inflation target readjustments that we have seen in this country? What is your assessment of some of the details in this November print?
Good morning, Jennifer. Good to be on the show. So yes, I mean, I think the headline number did surprise a little bit to the downside, coming in at 3.5%. I think most of that downside surprise, though, came from the more volatile components, non-core components like food. But outside of food, I think the print itself actually was not surprising at all to us. So core inflation picked up a nudge, but still this is sitting at 3.2%, very close to the central bank's new 3% point target. But underlying price pressures in this economy have remained very weak and very benign, and we expect that to continue through to 2026. So, our forecast for next year is quite well below the consensus. We have an average of about 3.2% again for inflation, which is in 2026, which is very similar to the performance that we've seen this year. So what didn't surprise us about the release was the fact that underlying or core inflation pressures remain extremely benign, and that's a combination of factors that are driving that. So I think on balance, this was a very encouraging and should be a very encouraging report for the South African Reserve Bank.
Did it confirm any of your expectations for where the SARB moves next then, Jeffrey?
So I think the SARB is not going to take sort of inflation prints for granted. Yes, we've had a lot of downside surprises in inflation over the past year. I think the SARB will be comfortable with that, but as we know, the SARB sets policies based on forward-looking expectations of where inflation is heading. Of course, there are risks in the system still, but at the end of the day, I think SARB's own forecast kind of suggests that inflation should remain pretty well anchored towards sort of 3.5% next year. Now, Does one CPI print, or a couple of CPI prints before their next MPC sitting at the end of January open the door for them to cut? Look, I think January is a possibility for a cut, but our view is that the central bank will probably want to take a more cautious approach from here on out. And so our view is that a quarterly pace of rate cuts going into next year probably makes more sense. So our view is that they probably will hold off on cutting in January and will probably resume cutting in March and then follow a quarterly pace of 25 basis point cuts until they get to 6%. So January is not off the table, but our view is that the central bank will probably want to take it a little bit more cautiously from here.
Jeffrey, we're taking a look at the dollar rand right now, and we have seen some notable appreciation for the rand over the past few months. I wonder, depending on who you speak to, a weakening of the dollar is going to be persistent through 2026 at the beginning of the year. Do you think that will be supportive of further disinflation in South Africa? What is your expectation for some of the volatility for the rand?
Yes, I mean we are constructive rand for sort of idiosyncratic factors. So we think that the growth picture picks up a little bit more meaningfully next year. We have a growth forecast of about 1.6%. I would argue maybe even with some upside risk to that. We think that there is a lot of value in South African government bonds, and that will continue to bode well for inflows, foreign inflows into SAGBs, but also local interest in SAGBs, which we think will be a firm driver of the currency. But in terms of the external backdrop as well, you mentioned an expectation for continued dollar weakness. That's something that we very much buy into here at BNP as well, and so we see that dollar weakness probably bodes very well for most EM inflation trajectories, in particular South Africa, and we see this as particularly relevant in economies with relatively high FX pass-through like South Africa has. I think as well the external environment. There were stories early on Bloomberg around how oil prices have hit hitting lows again, and I think our base case here again is that oil will remain crimped by meaningful supply overhang. So again, I think a stronger currency coupled with things like a weaker oil price is a very disinflationary outlook. If you add on top of that the fact that China is continuing to export more deflation into the rest of the world, all of these factors, I think, remain very supportive of a disinflationary narrative. But certainly the currency element, I think, should provide a lot of scope for, I suppose, disinflationary pressure to remain quite well entrenched in the South African economy next year.
How do some of the gains that we are seeing in precious metals, Jeffrey, play into that narrative as well?
Yes, so terms of trade, I think, is definitely one of the factors that I think are helping the currency. We've obviously seen, nearly a 70% rally in gold prices year to date. South Africa is a large gold producer. Obviously, this matters. On top of that, the oil price. South Africa is a net oil importer, so as a result, net your terms of trade environment is very supportive for the currency. We see that in the current account of the balance of payments dynamics. Our expectation is that the current account over the next year is probably going to average somewhere around 1%. Current account deficit is going to average somewhere around 1% of GDP, and a trade surplus of about between 2 and 2.5% of GDP. So these are very supportive factors as well for the currency. So absolutely, I would say that the current commodity price environment, particularly in precious metals, is very much a favorable tailwind for continued ZAR outperformance.
Yeah, good to take a look at some of those external factors as we zoom in here to South Africa. Jeffrey Schultz, head of CEEMEA economics at BNP Paribas Markets 360, joining us in London. Jeffrey, thanks so much for your insights. And let's just stick on one point Jeffrey was mentioning there. Oil is on track for its biggest annual decline since the pandemic as a glut of supply stalks the market. Tankers filled with oil are idling on the world's seas, waiting for the market to pick up. For more, we're now joined by Bloomberg's Anthony DePaola. Anthony, Anthony, what is driving this surge in supply? We've been speaking for months about potentially what this portends for 2026, but give us some background.
Good morning, Jennifer. Yeah, that's right. Basically, it's additional production coming to the market. So we've got producers like Guyana in the Americas that has brought on new oil fields, and so that's pumping new oil into the market. The United States, there's a lot of talk about how the lower prices are not conducive for production there. So we are seeing a tapering off of growth, but still, the U.S. is a massive producer, so still pumping a lot of barrels out into the market. So we're seeing those additional barrels come to the market from those non-OPEC plus producers. And then on the OPEC plus side, because they have seen those competitors taking market share from them, because they have seen the writing on the wall in terms of prices, they've decided to kind of forego their previous defending the price policy and get back into a regaining market share policy. And so they've eased constraints. They've increased the quotas progressively over this year, and they've added a lot of new barrels to the market. Just Saudi Arabia, for example, is up on about 1 million barrels a day of production just this year because of the barrels that they've brought back. They are going to take a pause in the first quarter of next year because they do see that glut building and they do see that weighing on the prices. But they have brought oil back as well too. So there's a lot of oil in the market. Demand in some areas has not been as good as it should have been. It's moderated a little bit in China, but still growing. So we still do see top line crude oil demand growth growing, hitting new records every year. So it still is up there. We've just seen it slow a little bit compared with the amount of oil that we do have in the market, Jennifer.
And Anthony, we've been talking about the pressure that Brent is already under. We've taken a look at the prices over the past few days. How low could we see prices realistically go, though, considering some of those factors you just pointed out?
Yeah, I mean, a lot of people are talking about the prices now being under pressure, but also saying that with that amount of oil coming to the market, and oil, of course, is a futures market, so people are looking forward at that oil coming to the market. They're saying with that amount of oil in the market and the perception of that coming glut, prices should be a lot lower, but for the geopolitical concerns that are holding things up. We don't know whether there's going to be additional sanctions on Russia. We don't know whether there's going to be additional fighting in the Middle East. So there are a lot of question marks that investors have that are looking at oil prices and saying, you know, not putting them as low as they should be. However, as we get into next year, when that glut does materialize, all other things being equal, if we don't have real flare-ups in geopolitical concerns, then people are talking about those prices dropping from where we are now. So we're already in the 50s, but kind of around that 50 level. So that would be another $10 off, and so that's quite a bit. We're already down about a fifth this year. As you said, we're into a second weekly decline. So oil is going to end the year on a low note, and the risk is that it goes lower next year. Markets have been very resilient to geopolitical pressure over the past 2 years, in that we haven't had prices spiking up consistently on geopolitical concerns, because investors are looking through that and looking at seeing if there's real supply disruptions, which we haven't had to date, and they're looking at that supply coming on. So they're seeing a very well supplied market. Again, with that demand that continues rising, but just ticking up, not growing as quickly as the demand coming into the market. And so that's the imbalance that we have. That's leading to oil in storage, which is always a bearish factor for markets. So that's really what we're looking at going into next year, Jennifer.
Yeah, and certainly going to be something I'm sure we're talking about for quite some time. Bloomberg's Anthony DePaola. Anthony, thank you so much for your reporting. And you can read this story and all of our previous big takes on the terminal. Just type NI Big Take Go, and also on Bloomberg.com. Definitely check that out. It's a great read. Now, coming up, European Union leaders have agreed to loan Ukraine 90 billion euros after failing to break the deadlock over using Russian assets frozen on EU soil. We have the details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. EU leaders meeting in Brussels have agreed to a $106 billion loan to Ukraine. The funding will be delivered using joint debt rather than frozen Russian central bank assets.
The member states have agreed to finance the Ukraine through EU borrowing on the capital markets for an amount of 90 billion euros for the next 2 years. We will do this by way of enhanced cooperation that is backed by the EU budget headroom.
Joining me now is Greg Sullivan, Bloomberg's Russia economy and government editor. Greg, thanks so much for being with us. So it seems like this potentially is a bit of progress if we're seeing these members coming together. Give us some more details on what we learned.
Right. Well, this agreement is actually the culmination of months of discussions and back and forth. EU leaders have been pushing to make this loan to Ukraine, which they see as very urgent, with Ukraine starting to run out of money and U.S. aid to the country all but dried up. For a long time, many leaders had been pushing to use frozen Russian assets, but Belgium had been resisting that. Most of the assets are actually located in Belgium, and Brussels had concerns about potential retribution or legal exposure down the road should they use the frozen Russian assets. So this deal actually marks a pivot for the EU, not breaking the deadlock over using those assets and instead borrowing against their own budget. But it also represents the urgency the bloc feels with funding for Ukraine at this pivotal moment.
So then, Greg, if we think about long term, is this the only solution that these leaders have come up with, or is there potentially a plan B that they still need to work out?
Well, some of the leaders did say that they're still open for discussions on what to do with the Russian frozen assets. One thing leaders did make clear is that Ukraine would not have to pay back the loan unless Russia actually paid compensation to Ukraine. So they will keep the assets frozen until reparations are paid by Russia. Now, of course, in recent days, Russia has been upping the pressure on Europe itself. It has taken to local courts to file a lawsuit against Euroclear and has threatened action against local banks with assets in Russia. So again, upping the pressure there to try to avoid the bloc's use of the Russian frozen assets.
All right. Greg Sullivan, Bloomberg's Russia economy and government editor. Greg, thanks so much for bringing us the latest on that story. Now, coming up, as U.S. inflation spurs a global equity rally, we look at the outlook and risks for the bull run in 2026. Details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Cooling U.S. inflation has spurred a global equity rally, with Asian shares climbing this morning. That's after European stocks closed at an all-time high, and Wall Street ended the day higher, with tech popping 2%. Looking ahead to 2026, positive momentum and a host of bullish forecasts should drive the U.S. stock rally, but there are still a whole host of risks ahead. And for more, we are joined by Farah El-Bahrawi, who leads our EMEA equity markets and strategy team, to dig into this. So Farah, of course, there are a number of themes that analysts are dissecting and trying to figure out what exactly 2026 is going to be dominated by. Let's just start with the risks potentially for U.S. equities that have had quite a bull run in 2025. What do you see as maybe a prime amongst them?
Absolutely, Jen. So that's the issue here. You have a very strong year. Analysts are expecting a fourth year of really strong gains heading into next year. So we're going into that with valuations quite rich, concentration quite high in the U.S. equity market. A lot of things really have to go right, just as expected, for next year. So if we look at the macro, we're expecting that exact Goldilocks scenario. Economy is resilient, but at the same time, weak enough for the Fed to comfortably reduce interest rates. And then, of course, the AI theme, that's something that's going to continue to be in focus. Companies are spending so much money to invest in CapEx. When are investors going to see a return on investment there? We've already seen some worries in some recent numbers with that, but it's going to be it's going to be a key theme heading into next year, as well as the concerns about the value chain and AI, and even jobs. If you think of how jobs are going to be impacted as adoption becomes more widespread. So again, and how that feeds into the economy. a lot of risks for investors to keep in mind heading into next year, certainly, and not barring even geopolitical shocks, even in potential inflation shock. Everything just has to go right for the S&P 500 to deliver on what's expected to be a record year. Yeah.
Yeah, and of course, AI valuations as well. Farah, maybe really quickly, what about Europe?
Europe, again, you have record optimism. Strategists are bullish. Buy side is bullish. Expectations for the economy are good, but there's a lot of room for disappointment. Are we going to see that fiscal stimulus feed into the economy? And profit expectations are extremely high for Europe as well. If we see some disappointment on that front, especially with the market having re-rated quite a bit this year, that's where the risk lies in Europe.
All right, plenty to watch out for. Just a few days until 2026. Farah El-Bahrawi, who leads our EMEA equity markets and strategy team, walking us through potentially some of the challenges ahead for equities. And let's just finish on equities right now. We were mentioning some of the upside that we did get yesterday. Initially, we saw some of the downside after some questions about tech valuations and AI, the AI trade, inserting a bit of negativity earlier on in the week. But S&P futures trading a bit sideways right now. NASDAQ futures looking a bit higher. If we cross the Atlantic, though, Eurostock 50 futures down about 0.3% there. So plenty to watch still for Europe, especially as we take effect on what Farah was just mentioning there. That is it for Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe. This is Bloomberg.